How to do investing like Warren Buffett, the blueprint to wealth and intelligent investing. You're listening to a guide to the mindset and methods of one of the greatest investors of all time, Warren Edward Buffett. For the next 15 minutes, sit back, relax, and imagine you are learning directly from the Oracle of Omaha himself. Chapter 1. The Foundation. Wealth is a mindset before it is a portfolio. If you ask Warren Buffett for his biggest secret, he won't hand you a spreadsheet. He'll hand you a mindset. Buffett believes the best investment you can make is in yourself. Before you buy a single stock or business, he says you must first build the habits of a successful investor. Think long-term. Avoid emotional decisions. Value patience over excitement. Learn continuously. Warren Buffett wasn't born rich. He built wealth not with luck, but with clarity. He understood money early, not as a tool for spending, but as a tool for creating more money. To invest like Warren Buffett, your greatest asset isn't your cash. It is your mindset. Chapter 2. The Magic of Compounding. Time is your silent business partner. Imagine you plant a single seed. It grows into a tree. That tree drops seeds, and soon you have an entire forest. That is compounding. Buffett learned compounding early. At age 10, he read a book called 1,000 Ways to Make $1,000. That's when he became obsessed. Not with money itself, but with what money could grow into. If you save and invest consistently, even modest amounts, time does the heavy lifting. Buffett once joked, "My wealth comes from living in America, some lucky genes, and compound interest." Compounding rewards the patient and punishes the impulsive. To invest like Buffett is to be loyal to time, not the market news cycle. Chapter 3. Value Investing. Buying a wonderful business at a fair price. Buffett learned from his mentor Benjamin Graham that there is a difference between price and value. Price is what you pay. Value is what you get. Anyone can buy a stock, but Buffett buys businesses. He asks, is the company profitable? Does it have strong competitive advantages? Will it still exist and grow 10, 20, even 30 years from now? Buffett avoids trends. He chooses boring, reliable, proven companies that sell products people will still need tomorrow. Insurance, food, railroads, energy, beverages, utilities. He is not interested in hype. He is interested in durability.
Chapter 4. The Circle of Competence. Know what you understand. One of the most misunderstood aspects of Buffett's success is not what he chooses, but what he refuses to choose. Buffett says, never invest in a business you cannot understand. You don't need to invest in everything. You only need to invest in what you truly understand. Your circle of competence might be technology, healthcare, real estate, retail, manufacturing. Whatever your circle is, stay inside it. The size of the circle is not important. Your honesty about its boundaries is. Chapter 5. The Moat. Defending the Castle. Buffett compares a business to a castle. Its long-term success depends on its moat, its protection from competitors. A moat could be a globally trusted brand, patents, network effects, high switching costs, cost advantages, superior distribution. Coca-Cola has a moat. Apple has a moat. Amazon has a moat. Buffett invests in companies whose moats cannot be quickly copied or destroyed. Because in investing, defense matters as much as growth. Chapter 6. Management Matters. betting on people more than numbers. Buffett studies financial reports, but he studies people even more. He looks for leaders who are ethical, think long-term, love the business, not the stock price, treat shareholders like partners. He avoids companies with overcomplicated financial statements, overly promotional CEOs, high executive turnover, short-term thinking. His philosophy is simple. You can't make a good deal with a bad person. Buffett doesn't just invest in businesses. He invests in honesty and competence.
Chapter 7. Market Behavior. Be fearful when others are greedy. Buffett does not fear market crashes. He waits for them. He says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Market emotions create prices, not rationality. When the market is euphoric and stocks are expensive, Buffett waits. When the market panics and great companies go on sale, Buffett buys. To invest like Buffett is to stay calm while others react. Money flows to the patient, the disciplined, and the unemotional. Chapter 8. Diversification. Not too much, not too little. Buffett is not a fan of owning 200 stocks. He says, diversification is protection against ignorance. If you understand what you're doing, you don't need endless variety. He focuses on strong conviction and deep research, not on spreading money thin to feel safe. But he does diversify across industries and sectors to limit risk. Buffett's version of diversification is simple. Keep all your eggs in strong baskets and watch those baskets closely.
Chapter 9. The Power of Holding. Wealth comes from not selling. Many investors chase excitement. Buffett chases duration. He has held some investments for 30, 40, even 50 years because a business multiplies when you hold it long enough to see the compounding happen. Buffett doesn't ask, how much can I make this year? He asks, how much can this business earn over my lifetime? That is the difference between getting rich slowly and never getting rich at all.
Chapter 10. The Buffett Blueprint. If Buffett had to summarize investing in a few steps, it might sound like this. Spend less than you earn. Save consistently and invest automatically. Buy great businesses, not hype or excitement. Hold your investments for decades. Keep emotions out of your decisions. Keep learning forever. Investing is not a lottery. It is a discipline.
Chapter 11. Emotional Intelligence, the Silent Engine of Wealth. A stock chart doesn't ruin investors. Emotions do. Fear makes people sell great companies when prices fall. Greed makes them buy weak companies when prices rise. Buffett warns, if you cannot control your emotions, you cannot control your money. The stock market had one job, to test your emotional intelligence. Every day it asks you, will you react or remain rational? Will you follow the crowd or think for yourself? Will you chase excitement or consistency? Buffett treats investing like a business decision, not entertainment. He reminds us, it's not about being smarter than others, it's about being calmer than others. To invest like Buffett is to master your emotions before you master your portfolio. Chapter 12. Avoiding Traps, What Buffett Refuses to Touch. Sometimes the best investment decision is not investing at all. Buffett has avoided cryptocurrency speculation, most IPOs, over-leveraged companies, penny stocks, businesses with no clear profitability. His philosophy: only invest in a business that even an idiot could run, because one day an idiot probably will. Buffett avoids businesses dependent on constant debt, companies built on trends instead of fundamentals, businesses whose success relies on unpredictable behavior. Avoiding traps is not about fear. It's about staying selective. In Buffett's world, there are no called strikes in investing. You can wait for your perfect pitch. Patience protects your wealth more than excitement ever will.
Chapter 13. Reading and Lifelong Learning. The Investor's Superpower. Warren Buffett spends 80% of his workday reading. He reads financial reports, history, biographies, and economic research. He studies success, but he studies failures even more. He says, knowledge builds up, like compound interest. The more you learn, the better you recognize opportunities. The faster you detect risks, the wiser your decisions become. Investing isn't memorizing formulas. It is understanding the world. Buffett believes every page you read is a deposit into your mental bank. Eventually, that bank returns dividends greater than any stock. Chapter 14. Living Below Your Means. The Hidden Strategy Behind Buffett's Wealth. It may surprise you that the man worth billions still lives in the same house he bought in 1958. He doesn't live lavishly, not because he cannot, but because he doesn't need to. Buffett says, if you buy things you don't need, soon you'll have to sell things you do need. Living below your means doesn't mean deprivation. It means freedom. Freedom to invest. Freedom to say no. Freedom to think long-term. Most people upgrade their lifestyle when their income rises. Buffett did not. He upgraded his investments instead. Wealth is not built by how much you earn. It is built by how much you keep and grow. Chapter 15. Legacy. Building wealth that outlives you. Buffett is not simply building wealth. He is building impact. His greatest plans for his fortune do not end with him. He has pledged over 99% of his wealth to charity, because true wealth is not measured only in dollars. It is measured in influence, impact, and generosity. Buffett reminds us, someone is sitting in the shade today because someone planted a tree a long time ago. Investing is not just financial. It is emotional. It is generational. It is transformational. To invest like Warren Buffett is to build something bigger than yourself, to plant trees whose shade you may never sit under, but others will.
Chapter 14. Living Below Your Means. The Hidden Strategy Behind Buffett's Wealth. It may surprise you that the man worth billions still lives in the same house he bought in 1958. He doesn't live lavishly, not because he cannot, but because he doesn't need to. Buffett says, if you buy things you don't need, soon you'll have to sell things you do need. Living below your means doesn't mean deprivation. It means freedom. Freedom to invest. Freedom to say no. Freedom to think long-term. Most people upgrade their lifestyle when their income rises. Buffett did not. He upgraded his investments instead. Wealth is not built by how much you earn. It is built by how much you keep and grow. Chapter 15. Legacy. Building wealth that outlives you.
Buffett is not simply building wealth, he is building impact. His greatest plans for his fortune do not end with him. He has pledged over 99% of his wealth to charity. Because true wealth is not measured only in dollars, it is measured in influence, impact, and generosity. Buffett reminds us, if you buy things you don't need, soon you'll have to sell things you do need. Living below your means doesn't mean deprivation. It means freedom. Freedom to invest. Freedom to say no. Freedom to think long term. Most people upgrade their lifestyle when their income rises. Buffett did not. He upgraded his investments instead. Wealth is not built by how much you earn. It is built by how much you keep and grow.